When most people think about buying a home, their minds jump straight to things like the down payment, the mortgage rate, maybe even homeowners insurance. But there's one piece of the puzzle that often gets overlooked, and it can make or break your monthly budget: property taxes. Now, before you even think, taxes? Really? Do I have to? Stick with me here, because understanding property taxes isn't just about paying another bill. It's about knowing how your community works, how your mortgage payment is structured, and how to avoid unpleasant surprises that can pop up months down the road. Here's the thing: property taxes are like your neighborhood's subscription fee. They keep the lights on in your schools, the roads plowed in the winter, and the fire department ready if you ever need them. Without them, communities wouldn't function. But for you as a homeowner, they're also one of the most consistent expenses you'll face. So if you're a first-time buyer or simply haven't considered this before, getting a handle on how they work can give you real peace of mind. And by the end of our time together, you'll know exactly what property taxes are, how they're calculated, and how they affect your mortgage payment, and some smart ways to keep them manageable. Plus, I'll give you a simple roadmap for staying organized so this doesn't feel overwhelming. Oh, and before we dive in, if you want a deeper breakdown of all the costs that make up a mortgage, I've put together a free first-time homebuyer guide. It's linked below, and it walks you through step by step the principal, interest, taxes, and insurance, the whole package. So let's start with the basics. What exactly are property taxes? Property taxes are collected by your local government, usually your county or city, to fund community services. Think about the things you rely on every day but probably don't notice: schools, road maintenance, trash collection, parks, libraries, fire and police protection. All of those services are supported, at least in part, by property taxes. When you become a homeowner, you'll pay them once or twice a year, depending on how your county structures things. And while it might feel painful to write that check, it's worth remembering that those dollars don't just vanish. They come back to you in the form of safer streets, stronger schools, and a more desirable neighborhood, all of which ultimately help protect your home's value over time. Now, how do they actually figure out what you owe? It comes down to two main ingredients: your home's assessed value and the local tax rate. The assessed value is determined by your county assessor's office. It's not necessarily the same thing as your market value, the price a buyer would actually pay for your house. In fact, assessed values can lag behind market values because assessments are updated periodically, not every time the market shifts. Then there's the tax rate, sometimes called the mill levy. That's set by your local jurisdictions like your city, county, and sometimes even special districts for schools or water. Multiply your assessed value by the tax rate, and there's your annual tax bill. Here's an example. Let's say your home is assessed at $300,000 and your tax rate is 1.5%. That means you're looking at a $4,500 annual property tax bill. That's the simple version. In reality, there might be exemptions or adjustments that bring the number down a bit, but that's the core calculation. So if you're house hunting, this is a great thing to check on ahead of time. A home with the same purchase price can come with very different tax bills depending on where it's located. Now here's where it hits closer to home: your monthly mortgage payment. A lot of first-time buyers don't realize this, but property taxes are often collected through something called an escrow account. Here's how it works. When you make your monthly mortgage payment, you're not just paying principal and interest, you're also chipping away at your annual property tax bill and your homeowner's insurance premium. That money sits in your escrow account, and when the tax bill comes due, your lender pays it on your behalf out of that escrow account. The benefit? You're not blindsided with one giant bill once or twice a year. Instead, you spread it out evenly across your monthly payments. The catch? If your property taxes go up, maybe because your home's assessed value increased or your community voted to fund a new school bond, your escrow amount goes up too, which means your monthly mortgage payment increases. If you don't use escrow, then you'll pay property taxes directly, usually in one or two lump sums. That can work fine if you're disciplined and setting aside money each month, but if you're not careful, it's really easy to be caught off guard. Imagine getting a $4,500 bill in the mail and realizing you didn't save for it. not fun. This is why I always tell buyers, whether you use escrow or not, make sure you understand the tax picture before you close. All right, let's talk about the what if scenario. What happens if you don't pay? The short answer is don't go there. Property taxes are not something you can just ignore. If you pay late, you'll face penalties and interest. And if you continue not paying, the county can place a tax lien on your home. That's a legal claim against the property. And in the worst cases, it can lead to a tax sale or even foreclosure. If you've got an escrow account, your lender is making sure those taxes are paid on time. But there's a little caveat. If your escrow balance runs short because tax rates increased and your monthly payment wasn't adjusted quickly enough, you'll get what's called a shortage notice. That means your lender will either raise your monthly payment to catch up or require a one-time payment to cover the gap. If you're handling taxes yourself, it all comes down to organization. Confirm your county's due dates, set reminders, and create a simple system for budgeting. Honestly, even a reoccurring note in your phone calendar can save you hundreds of dollars in penalties, not to mention the stress of scrambling at the last minute. Now for some good news. There are ways to potentially lower your property tax bill. First, check for homestead exemptions or primary residence credits. Many states and counties offer them, and they can reduce your taxable value if the home is your main residence. Second, review your property assessment every single year. If you think it's too high, you can appeal. But here's the thing, you'll need evidence. That might mean pulling recent comparable sales in your area, hiring an appraiser, or documenting issues that have reduced your home's value. You're not arguing about the market in general. You're making a case that your specific assessment is inaccurate. Third, just stay organized. Keep track of due dates, budget for taxes monthly, even if you're paying in lump sums, and don't let the whole process sneak up on you. A little upfront effort can make a whole thing a lot less stressful. So let's pull it all together. Step 1, find your current tax rate and assessed value on your county's website. Step 2, calculate your yearly number and then break it into monthly amounts so you know the impact on your budget. Step 3, decide whether you'd prefer the predictability of escrow or the flexibility of paying directly. Step 4, check for exemptions so you're not leaving money on the table. Step 5, know your appeal window each year in case you ever need to challenge your assessment from the county. When you boil it down, property taxes are just another piece of the homeownership puzzle. They fund the services that make your neighborhood thrive. They're calculated based on your home's assessed value and tax rate, and they directly affect your mortgage payment. Miss them, and consequences can be serious. But with a little planning and awareness, they're completely manageable. And here's your gentle nudge. If you're just starting out, download my first-time homebuyer guide. It gives you a clear breakdown of mortgage costs, including principal, interest, taxes, and insurance, and how they all work together. If you're ready to start house hunting, you can connect with a vetted real estate agent in your area through our Agent Match Advantage program. It's free, and it ensures you've got someone on your side who truly has your back. At the end of the day, property taxes aren't something to fear. They're just something to understand. And once you do, you'll be able to approach homeownership with a whole lot more confidence.